Eric Stewart Show, pointing you home on WMAL.
Welcome back to the Eric Stewart Show. Sid Hamid joins me with Brickfront Properties and Construction. Sid is a powerful business driver whose entrepreneurial activities and instincts and his clarity of vision have carried multiple companies through rapid and continuous growth. And I'm glad, Sid, thanks for joining me today. How are you?
Hey, I'm doing well. Thanks for having me, Eric.
Absolutely. Sid had expressed interest. I had a property in Northeast Washington, D.C. And is that right, Sid? Have I got that correctly? Was that seventh place? Was that Northeast, I believe?
Yes.
And you had some interest in the property. We've since sold the property, and it didn't work out for your purchaser to buy the property. But you are a man about investing and building value. And after doing part-time real estate for quite a while with great success, you decided it was just time for you to focus all your attention and efforts exclusively on your real life passion. So tell us, what is your life passion?
Well, to be honest, my life passion, I'm going on 50 years old, is to basically to give back and to help others and to share my knowledge that I've gained over the different businesses and things that I've been part of. Mm-hmm. And so right now, I spend a lot of time teaching and educating people on real estate investments, and especially in D.C., Maryland, Virginia area. And this is where my family and I started back in 1989. And so we started in Springfield, and we just kind of worked our way down to Alexandria and D.C. and PG and Baltimore and so forth.
So what is it that your family started doing in 1989?
Well, when we bought our first house in Springfield, and we were living in some apartments, and they asked us to move. And so we basically bought the first house, fixed it up, and we lived there while we were fixing it. And that turned into a passion of doing construction and so forth. And from there, we just kept building. Then we bought another one in Arlington. Then we bought another one in Alexandria. And then we bought another one in Burke, Virginia. And we just kept doing it. And we saw the cash flow. We saw the freedom of time. And, I enjoyed it. So I stopped doing everything else that I was doing and just stayed focused on working with contractors and working with construction. And became the project manager of the different projects that we had. Mm-hmm.
And you've now sold over 400 homes, or done 400 renovations, I guess, since 2001 as Brickfront Properties. Is that my understanding?
Well, what happened is over the years I started to work with different developers. So I worked with Ryan, Mid-Atlantic Homes, and I was in charge of hundreds of houses. I had 80 different people working, roofers, plumbers, electricians, and they said, okay, we're going to build out this community. So I was building a lot of homes with those guys. And then when the market crashed, they laid everybody off, and I got stuck with a couple $100,000 worth of outstanding bills. And then from there, I just went back to working with institutions and buying REO properties and working directly with hedge funds out of New York and California, and buying bulk, like 10, 20 properties at a time. And so that's basically what we've been focused on. Okay,
so hedge funds that have purchased non-performing loans, is that what I would gather is what you're saying?
Yes. So right now we have a $5 million fund, and so we buy non-performing assets, first liens primarily. And so the goal is to work directly with some of the mini funds that do like $50 to $100 million. Mm-hmm. And so we buy it from them for anywhere from 50 to like 60 cents on a dollar. And then we'll wholesale some of them, we'll renovate some of them, and we'll just sell some of them to our other investor friends.
Okay. Do you see any ebbing in the flow of those properties right now, or are we in for another wave of non-performing assets? Just curious.
Oh, yeah. There's, as you know, the shadow inventory, there's been this huge conversation about shadow inventory for the last 6-7 years. And what Fannie Mae and Freddie Mac, that holds most of the paper, they've been basically selling these things in large bulks, like $100 million, $80 million, $200 million to like BlackRock and some of the other hedge funds. So there are still a lot of assets out there that are still coming into the inventory. And right now, the supply and the demand in the District of Columbia and the metropolitan area has shrunk because of the moratorium. There's been a moratorium in D.C. There was a moratorium in Prince George's community. So now that the governors and the mayors have lifted the moratoriums, so you're going to see a flex of inventory coming in to the marketplace.
Okay, so the moratorium's been lifted. You're going to see a lot more inventory coming to line now that's been kind of waiting to be released. Is that correct?
That's correct. Now, one of the things that some of these smaller hedge funds that are like $20, $30 million hedge funds, what they've done is they've decided to go in and rehab and renovate some of these homes themselves. So whereas before we would see the assets at 47 cents, 52 cents, 58 cents on a dollar, now when you look at an REO property in the MRIS system, they're already at 72 to 78 cents. So they've kind of taken a lot of the meat off the bones. So the deals are out there, but you have to have cash to be able to buy these deals at a better price. So they're coming out, but you have to be connected. You have to have right relationships, right resources in order to get these deals, and you have to have the cash to execute immediately.
Right, because you don't have the freedom of floating with a larger spread, meaning the difference between what you're buying and what you can sell it for is the spread and what your potential gain is going to be, including any improvements. And if you're having to pay 40% more than you were before for the same thing, you have a much thinner margin, much less risk, much greater risk for your finances. And so do you think this large pool of buyers are they much more competitive for the same assets? Do you have many more hedge funds coming in and buying, so they're not buying at 50 cents themselves, they're buying at 60 cents?
Exactly. Plus we have a lot of foreign international money from China, Japan, Russia. There's a lot of international money in the metropolitan area. So a lot of these folks are parking their money here. So they rather park their money in the U.S. at a 2-3% yield because of what's going on in China with the currency and what's going on with Russia and stuff. So there's a lot of international funds that are basically just dumping their money in trophy assets in D.C., in New York, in Chicago, and California, where these trophy assets are. And the U.S. government has created a program called the EB-5 program.
Yep.
And through that EB-5 program, there's a lot of cash that's laying around D.C. area.
Okay, I got to jump a slightly different direction. So if I understand you, with the banks are actually getting more money for selling those assets than they were probably just a year or 2 years ago because of the demand from the large pool buyers who are then selling pieces of it off to you, but they're charging you more, and therefore your spread is shorter. But that's bullish for the banks. The banks are actually getting more money at the end of the day. The middlemen, actually, the original purchasers, the large pool buyers, are trying to cut that meat off the bone for you because they're having to pay more.
Exactly.
All right. Question is this: is this all old foreclosure stuff, or is this more recent, or is this a combination? And what would you say is the percentage?
Okay, so as you know, when the loan modification program Obama created back in 2008, 2009, when they came out with the loan modification, there were a lot of people that applied for the loan modification, but since then they have gone back into the foreclosure position. So there's a lot of people that got approved, but now they're back into the foreclosure. They're not paying their loans again. But you have to keep in mind, people's incomes are the same. It's not like people's incomes has risen 20-30%.
Right.
Most people are still looking for that salary that they were getting in 2001, 2, 3, and 4. So income hasn't gone up. Employment is still, it's better, but it's not where it used to be, and people's confidence is still low, and people's savings accounts are still low.
Hey, Sid, thanks. I got to take a break. Got to come back with Stuart Rosenthal in just a second. You can get information on Brickfront Properties by going to ericstewartgroup.com, to our blog, and more coming up right after this.